Welcome to our investment analysis presentation regarding the current gold market. Today, we will examine the U.S. market outlook for April 2026, specifically focusing on the SPDR Gold Shares, or GLD. This report provides an in-depth analysis for the upcoming 5 to 15 trading days, offering a strategic perspective on one of the market's most significant safe haven assets. Beginning with our executive summary, the gold market is currently characterized by a wait-and-see consolidation phase. As geopolitical tensions in the Middle East stabilize, the initial war premium is beginning to fade, leading investors to reallocate capital into the equity markets. We have identified $440 as a critical support level for GLD. A breach below this threshold would signal that sellers have gained control. Furthermore, headwinds such as a strengthening U.S. dollar and rising bond yields are exerting downward pressure, prompting institutional investors to realize profits after the substantial gains observed earlier this year. The broader market narrative reveals a classic cooling period. Following the initial surge driven by uncertainty, the establishment of a ceasefire has shifted investor sentiment toward optimism, drawing liquidity out of defensive assets. Consequently, gold is currently embroiled in a tug-of-war between long-term holders, who view it as an essential inflation hedge, and short-term traders exiting the fear trade. Until a significant new catalyst, such as a surprise employment report or a fresh geopolitical development, emerges, we anticipate gold will continue to trade within its current range. 3 primary factors are currently driving the markets. First, geopolitical stability is easing the demand for safe havens. Any breakdown in diplomatic progress would be required to provide a price floor. Second, the appreciation of the U.S. dollar and rising bond yields are making gold more expensive for international buyers, thereby suppressing demand. Finally, we are observing a notable investor rotation, where finite capital is being moved out of gold and into equities as market confidence improves. Turning to the technical analysis of GLD, the overall condition is classified as consolidating or neutral. With the current price at $442.09, we are positioned just above the $440 support level, while resistance remains firm between $448 and $450. The Relative Strength Index, or RSI, stands at 52, which is essentially the midpoint of the scale. This confirms that the market is neither overbought nor oversold, reflecting a state of equilibrium as participants await the next significant news cycle. Regarding our outlook for the next 5 to 15 trading days, we have identified 3 potential scenarios. The most probable outcome, with a 60% likelihood, is sideways chop, where gold continues to fluctuate between $440 and $448. We assign a 20% probability to a bullish, fear return if economic data weakens or tensions escalate. Conversely, there is a 20% chance of a bearish breakout below $440 should the equity rally persist and the dollar continue to strengthen. It is essential to monitor these critical price levels closely. The $440 support level is vital for maintaining the current uptrend, and a close below it would indicate a negative shift in the short-term trend. The current price of $442 places us in a neutral no-man's land. On the upside, the $450 resistance level must be decisively broken to resume a bullish rally, an event that would likely require a significant external catalyst. Looking ahead at this week's economic calendar, 2 events stand out. The Friday jobs report is the primary focus. A weak report may pressure the dollar and bolster gold, while a strong report could enhance risk appetite and hurt gold prices. Additionally, we must pay close attention to Federal Reserve speeches, as any guidance on interest rates will directly influence the dollar's strength and, by extension, the valuation of gold. We must also remain vigilant for specific warning signs. A break below the $440 level would suggest that the short-term trend has turned bearish, necessitating a reassessment of positions. Simultaneously, any spike in the U.S. dollar index, or DXY, would act as a direct headwind. The convergence of these 2 signals would strongly indicate that a bearish scenario is unfolding, and these metrics should be monitored on a daily basis. The strategic implications vary depending on your investment profile. For long-term investors using gold as financial insurance, short-term volatility should not detract from the fundamental case for gold as a hedge. For short-term traders, the current environment is challenging, and it may be prudent to wait for a confirmed breakout of the $440 to $450 range. For risk-averse investors, remaining on the sidelines is a valid strategy, given that gold is currently in a state of high sensitivity to headline news. To summarize the key takeaways, the fear premium is receding as geopolitical tensions cool and momentum remains neutral with an RSI of 52. We expect the market to remain range-bound between $440 and $450, representing our most likely outcome. Ultimately, the market is in search of a catalyst, with Friday's employment data and upcoming central bank commentary serving as the most probable triggers for a directional move. This snapshot provides a comprehensive overview of our analysis as of April 20, 2026. With GLD currently at $442.09, the market is in a neutral consolidation phase. We have clearly defined our support at $440 and resistance at $448 to $450. The primary risks to monitor involve a breach of support or a spike in the dollar index, while the upcoming jobs report remains the primary catalyst for change over the next 2 weeks. Finally, please take a moment to review this important notice. This analysis is based on market conditions as of today and is intended for educational and informational purposes only. It does not constitute personal financial or investment advice. Because markets are subject to rapid change, we strongly recommend conducting your own research and consulting with a qualified financial advisor before making any investment decisions. Remember that past performance is not a guarantee of future results.